Hey everybody, Lee Perkins here. Hope you had a great weekend. Hey, I know I've gotten a couple of phone calls and a few texts this morning from folks who were wondering what's going on with the stock market. So I thought I'd send a video to give just an update, a little bit of try to provide a little bit of perspective. So that's what I'm going to do here this morning. I'm going to start off by showing, let's go here. Yes, hopefully you can see my screen now. So if you've been in the office over the last maybe 2 or 3 years, you've seen this screen and it says we help good people make great decisions so they can have an amazing retirement. So it's times like this where we're really trying to do our best to help people make good decisions and wise decisions. And panicking based on what's going on in one day or maybe even a couple of weeks is not always the greatest thing. But I understand this is real. This is your money. This is your account value that's going down. So I understand that, and I'm very sensitive to that. So I want to provide you with an option today that is way better than just hitting the panic button. All right. So let me see if I can go down here. All right. So if you've been in the office, you have seen this chart here. The gray bar is where the S&P 500 finished year to date. So as you can see, and this is from 1980 to really March of 2023. So the gray bar represents where the S&P 500 finished for the year in a calendar year. The red line is how far down the market got during that year. So you can see there's a lot of times where the market goes down and then winds up finishing positive for the year or not nearly as bad as it was at some point during the year. So I just want to provide that perspective. And again, the market's positive in 32 of 43 years. Here's another one that I thought was good for me to show you all again. I've shown you this before. If you just look at things in a 1 year time frame, and with stocks being in green, bonds being in blue, and a 50-50 diversified portfolio being in gray, in a 1 year time period, you can see there's a pretty significant range of returns. But if we look out to a 5 year rolling time period, you can see that the downside is very, very low and the upside is still very strong. And if you go out 10 years, again, the downside it gets even lower and still a really nice upside. So I just want to provide that as perspective to sort of keep that long-term focus as you look at this. Now, I know that as you're looking at your accounts and you see the balances dropping, sometimes you're like, well, I don't care about that. This chart here tells us why we can't try to predict where the market's going to go or which asset class is going to have the best return. I sometimes refer to this as a Skittles chart. As you can see, all of the different asset classes are represented by a different color here, and there's not a consistent winner. Right here in white is the one that is a diversified portfolio. It's never been the highest, but it's never been the lowest too. So that's why we preach investment diversification. So here's what I want to introduce you to today to as an option to a total sell-off going to cash. And this is a 6-month buffer ETF. Now we've been using buffer ETFs for a while now, but typically it's been for a 1 year time period where the upside cap, may be anywhere from 13 to 15%, and the buffer is a 15% buffer on the downside. What this is a 6-month buffer. It started in July and it ends on December 31st. So we're basically a month into this 6-month buffer. What this is a 100% buffer on the downside. So you can see right there, no matter if the S&P 500 goes down 3%, 5%, 10%, or 25%, you have a 100% buffer to where you are protected from that downside loss, as long as you leave the money in there for the defined outcome period, which we've got about 5 months left. So it's actually called a defined outcome ETF. We refer to it as a buffer ETF because you have a buffer on the downside. So that's it in a nutshell. What does it look like in real life? Excuse me. You can see the red line there. So let's just assume the worst and the stock market just continues to go down all the way to the end of the year. All right. So I'm just saying that's the S&P 500. I'm not predicting that. I'm just showing you this as an example. That red line is the S&P. This black line would be your account in the 6-month buffer ETF. Yes, your account value can still go down, but by the end of the year, it is going to trend back up so that you will finish without a loss in the markets. All right, you're going to realize that full 100% downside. So you don't want to. We can't do this in an account that you are taking money from. So if you're taking a monthly distribution, we'll just have to have another conversation, do a quick workaround with that, and we can certainly do that. So now let me show you what it's like on the upside. It's pretty simple. If the S&P 500 is up 8%, like I showed you in this example, then you're going to be capped at 4.3%. That is the remaining buffer that's left in this July 1st to December 31st buffer. So there's 4%, 4.3% upside between now and then, no downside. So anyway, that is it in a nutshell. That's the idea. It's way better than just moving to cash. What money should you consider doing this for? It's completely up to you. I'm not recommending that anybody does this, but I'm giving this to you as an option, as something to consider if you're one of those people who cannot remain disciplined and your mind is playing tricks and you think your account is going to go to zero. It's not going to go to zero. It's never done that in the past. The market has never gone down without coming back up. So being disciplined, it will come back. We have no idea when it's going to come back. Will it come back in a week or month or 6 months or a year? We don't know, but it will come back. I can promise you that. If you have any questions, please reach out to the office. You can shoot me an email as well, and I'm going to be available to have conversations with as many of you as I need to. So that's it for today. Thanks a lot. Take care.